So basically, I mean, normally we have a saying that what you learn from history is you don't learn from history. But we try to learn from history, and that's why we look at the markets, the big markets that have done what India is expected to do in the next 5 to 10 years, right? We're gonna be the third largest economy. There's no doubt about that. We're gonna be the fastest growing economy. Again, no doubt about that. So let's look at the big economies which did that, like the US or say China or even Germany and Japan to an extent. So whenever this growth rates kicked in, it was the clear winner was the BFSI sector. Mainly the growth rate kicked in because I mean the growth rates picked
Okay.
up because of consumption kicking in the GDP space, right? So it was more of consumption driving the GDP as such than the investment part. When that happens, the BFSI space has a double whammy because they not only fuel the consumption by way of giving out loans, credit cards, unsecured debts, and stuff like that, but they also fuel the back end of the economy, the consumption, which is the manufacturing companies
Okay.
needing working capital and stuff like that. So inventory man and so on and so forth, right? So it's a double whammy for these guys, and that's why we are, and we remain overweight on BFSI. In fact, massively overweight on BFSI. I think our weight is in excess of 45%, if I'm not mistaken, in most of the funds that have diversified holdings per se. And obviously, the lenders being what they are, they are heavyweights within the sector itself. Having said that, even the lender space, we don't have much of public sector lenders, banks rather, and that's mainly because they are into project financing and stuff like that. They're not the consumer facing banks. Most of them are more of project financing. So that's why the only public sector bank that we have is SBI, which is, I think, a fairly heavyweight on consumer financing. And private sector banks we like because of the way they are in consumer financing. They're very, very nimble footed as such. Yeah. So that's the reason why we are more heavy on private sector than on public sector. And secondly, having you said about what RBI's actions will have impact on the lending space. Now, having seeing that the RBI used, I won't say a bazooka, but a bunker buster by way of giving a 50 bip cut in interest rates and a 1% cut in CRR, I think that will have a bit of an impact on the banks. The earlier cuts were fairly nimble. I mean, they were absorbed on the way along, but the NIMs will definitely have a problem. In the private sector, we expect the NIMs to have probably this quarter will be the biggest reset for NIMs. Going into the next quarter, and they've been nimble-footed. They would cut their deposit rates and stuff like that. But the next quarter, I think they'll be more or less insulated to that extent. But do not forget, with this kind of a CRR card, the liquidity also which comes into the system helps them to absorb this to a greater extent. And that was also needed. So I think banks will come out of it fairly quickly. The NBFCs, however, are clear winners. They are the ones which are, I mean, on a short cycle on both legs of the balance sheet, be the lending or the borrowing. And anyway, they were having problems of borrowing because of the tight liquidity in the system. And with this liquidity infusion, I think they're a better place. So you'll see that our mix also has changed quite appreciably towards NBFCs than towards the banks.
If you like the video, do like, comment, share and subscribe.